Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Yes, welcome to Ask Rob and Rob, a straightforward podcast. I think you'll agree. A podcast that delivers. You ask, we answer. And you've certainly been asking. We've had some fantastic questions in. Got a couple of good ones for you today. So we'll get straight into those after Rob has given you a quick reminder of how you can send in a question of your own.
Okay, so super simple. You can go to the website, thepropertyhub.net/ask. Type that in. Leave a recording there. You can try as many times as you like. Don't worry if you get it wrong first time. Or you can call in on 013 808 00035, normal rate supply, and leave your message on the answer phone there. However you prefer to do it, we obviously make it easy enough because we've got plenty of questions in and two really good questions this week. And we start with Anthony.
Hi, Rob and Rob. This is Anthony. Thanks very much for all the brilliant podcasts. I'd be really interested if you could talk about some properties or property investments that either of you have rejected and why. We do hear a lot about the brilliant opportunities that are out there, and it would be really interesting to be able to draw the contrast with the not so brilliant opportunities that are out there, so that certainly I and hopefully everybody else could avoid those. Thanks very much for your help.
I'm excited, Rob. This is the question I've been waiting for, because actually we do talk about things that go right, and we talk about things that go wrong as well. But I can probably lift the lid here on a few things only recently that will, I'm sure, be interesting for the listeners.
Yeah, I was really excited when I saw this one come in because I thought, I look at a lot of stuff, but that's just for me. And most of the stuff I look at is perfectly okay, but just not for me for one reason or another. But for what you do with RMP, you're going to be looking at so much stuff all the time and at a slightly different level as well. And I know that there's going to be a lot that people can learn from. So take it away.
Okay, so I'll give you some very recent examples because we literally turn down multiple deals every week. So a recent example was offered a deal in Northampton. It's probably still on the market. It was a number of apartments. I think it was 11. And we got to see it before it went to auction. Now, the person who presented this to us claimed it was at a discount, which in theory I could understand why, because it's going to auction. And often if you get it pre-auction, because you know the right people, there can be on occasion a good deal there. This particular one, looked into it, and it wasn't. It wasn't for a few reasons. One, there weren't many apartments or like-for-like apartments in the area, which doesn't mean it's not a right deal, but it's just something to be aware of. So you look for your comparables. Now, we could send in a surveyor, but in this case, we just looked at the recent sold prices because in that block, there was at least another 11 in there as well. In that block, sold prices within the last 12 months were around about, if not below, at the discount level we were being offered. So that was an easy no, but it just shows you a few quick checks can help you assess a deal. If the comparables aren't there, look at sold prices. You can access them for free on Rightmove. Really simple check, but it gives you an indication of where the value lies on an investment, particularly if it's been marketed at a discount or below market value. So that's one. Another one, slightly different twist, looking at a development in Greater Manchester. I won't be too specific because I think it's still for sale and people are probably buying into this and I don't want to get sued. But there's a development there, an office block that's being converted to apartments. But it's the type of construction that this office was made out of that made me a little bit nervous. And it made me nervous because of mortgageability. So what we did is we asked a mortgage broker, who we trust implicitly, to go and research the block. The great thing is, he didn't have to do much research because this mortgage broker is from Manchester, and he said, don't touch that development with a barge pole. You will not be able to get mortgages for your clients. So we didn't. It was painful because on paper the price was good, the location was spot on, the fundamentals were there, but mortgageability wasn't. So we had to walk away, and that would have been multiple deals, but it was the right thing to do, obviously. But it just shows you, again, just all the things you have to check and account for, especially if it's off plan in that particular case. You don't want to start putting your money down and realise you can't get a mortgage later on. Now, of course, it can still happen with all the checks, and we always do the pre-checks. Things happen. It's just part and parcel of property investments. But the more checks you do up front, the less risk further down the line. And then finally, I'm going to give you more a dramatic one. And we were talking about this just before we recorded the question. A little while back on Ask Rob and Rob, somebody asked us about a development in Liverpool. And I was familiar with this development. It was in Chinatown. And this developer had a few sites scattered across Liverpool. Now, I tried to give a subtle warning on the Ask Rob and Rob at that point that there's a lot of commissions baked into them. The reason I can say now, because this company's gone under, so I can be more open on this particular topic, is the reason I knew that is because it was offered to RMP. We said, don't give us the commission, which was about 12%, and we'll have that as a discount for our clients as well. And we were looking to do a deal with them, give it to the clients at a 12% discount off the market, so everybody else would have been buying at full price. We would have got it at 12% off. We started to progress the deal because the locations were really, really good. And one of the things we always look for is deposit protection. So if you're buying off plan, is your deposit protection? Now, on paper, it looked like there was deposit protection, but we go to some lengths when we do off plan. We took that guarantee and took it to a solicitor to say, is this solid? How they're proposing to protect this deposit, is it solid? Her advice was, it's not worth the paper it's written on. We quickly backed out the deal, even though we loved the location, the development looked great, the discount was great compared to what everyone else was paying, but we walked away. So glad we did. So Google something like Chinatown development and then Liverpool Echo, and it'll come up, it'll tell you all about it. But hundreds of thousands, if not millions of pounds of deposits have been lost. A real tragedy and an echo of what happened in the past with off-plan, where people would buy in. On paper, it looks safe, but they were burnt. It was mainly overseas investors, actually, who were burnt by this. And it's absolutely awful that it's happened. Hopefully, this podcast can be a word of warning to you all on not just check, is it a good deal? Like, are the fundamentals there? Will it cover its costs? Will it get a reasonable yield? You know, all the traditional stuff you look for, yes, is absolutely important. But remember, there's a lot more to it. And hopefully this podcast will give you a few ideas on the type of things you should be looking for beyond just the simple checklist that we kind of normally talk about. So, Anthony, I can't thank you enough giving me the opportunity to talk about that, and hopefully will help many people and save lots of people cash.
Well, there you go, Anthony. How's that for an answer? That's the great thing about doing this podcast. That's the kind of thing that wouldn't have worked necessarily for a full episode of the Property Podcast. It's the kind of thing that maybe we'd chat about between the two of us, but never get around to putting on air. And you gave us a brilliant opportunity to do that, so everybody else could learn from Rob's experiences. So thank you, Anthony. Great question. So that's plenty of value already, but we've still got another question to come. This is from Tom in Auckland, so let's hear what he's got to ask.
Hi, Rob and Rob. It's Tom from Auckland here. Thanks for all the great work and the podcast. It's some great information there, so thank you very much. Quick question. My girlfriend owns a flat in Edinburgh. It's a 2-bedroom flat. She's owned it for near enough 10 years now. It was originally, she bought it to live in, and we lived in that prior to moving to Auckland. Since we've been in Auckland, she's rented it out, which is, I guess, coming up to a year now. When we return to the UK, she has the idea of selling it. I wanted to get your thoughts on this, really. She wants to get the deposit out of it, which is around 60k. It hasn't moved up much in terms of value. The mortgage is a typical residential mortgage. So it's not on interest only, it's not a buy-to-let mortgage. So the margins every month aren't great. So it'd be good to know your thoughts in terms of selling it, releasing some cash from it to then purchase a house ourselves between the two of us, and possibly another investment property done in the right way, chosen for investment purposes. Thanks a lot for your help. I look forward to hearing your answer. Thanks.
Okay, thank you, Tom. So your girlfriend's got a flat in Edinburgh, owned it 10 years, and you're deciding whether to keep it or refinance it, or basically what to do with it. I must say I'm surprised that she's owned it for 10 years, it's in Edinburgh, and there hasn't had much in the way of growth, because Edinburgh has been performing so strongly recently. So obviously don't know where in Edinburgh it is, but I am surprised it hasn't had any growth. That's an assumption to check, maybe. Obviously, you know far better than I do, but it's just something worth having a look at just in case. Also, if she's been on a repayment mortgage for 10 years, I'd expect there to be more equity in it now than there was before, because of course she's been paying off the capital as well. So again, you're much closer to this situation, but it's worth taking a closer look at the figures if you're working off assumptions rather than actually really digging into what's it worth, what's the mortgage balance, and so on. But assuming this is the case, then what should you do with it? It's a tricky one. Because, of course, if it was bought originally to live in and now it's not really performing as a buy-to-let, then you're obviously thinking there are better things to do with the money. But at the same time, it's very painful to sell an asset because you're worried about what the price is going to do in future. And also there's lots of costs involved in that as well. So the way that I would approach this, I think, would be first of all to look at what I could do with that property to get it performing better. So if it's that the repayment mortgage is meaning that you're making very little cash flow on it and you'd like to be making more, then I'd look at the options for turning that to a buy-to-let mortgage. Now, on a residential, you could need as little as a 5 or 10% deposit, where the buy-to-let, you'll need more like a 20-25% deposit. But like I said, if that's been being paid down for 10 years, I'd hope that equity was in there. So you might be able to switch it over to a buy-to-let, be making more money from it, be feeling better from it, and hold on to that asset and get its appreciation over time. But if that's not going to work for some reason, or it's not going to make a big difference, then I think the question is, well, what would you do with the money if you had it? So if you sold it and you ended up with a 60k, what would you be able to do with that? You mentioned using it to buy a place to live in. Well, if you want to do that, and if that would make a big difference for you, then obviously that's something to consider. There's more to life than just looking at things purely in terms of investment. Or you mentioned using it for a buy-to-let. So if you're able to then take that, use it for a buy-to-let and make a far higher return than you would with the flat, then maybe that's an option as well. So the first thing that I would do is figure out what can you do with the flat as it is now. And then as a second stage, if you're not happy with that, think about what you would do with the cash if you had the cash instead. And if it's compelling enough, then maybe it's time to bite the bullet and sell. So it is a tricky one, Tom. This kind of thing always is, but hopefully that gives you a framework to work with as you approach some of these decisions.
Well, there we go, Rob. 2 questions, and if I don't mind giving us a bit of praise, which we're quite comfortable doing, I think 2 rock-solid answers. Another thing that's rock-solid is our commitment to the Property Podcast, which will be back on Thursday, and of course, we'll be back next week with Ask Rob and Rob. So until then, thanks everyone, thanks for your questions, take care, and bye-bye.
Bye-bye.